The down payment. For most real estate investors in Canada, the down payment is considered one of the biggest hurdles to owning an investment property. Everyone focuses on the magic number, the 20% down. But here is the Streetwise reality. Focusing only on that number is a classic rookie mistake. The truth is, there are actually 3 percentages that you need to be aware of as a real estate investor. Numbers that can unlock different strategies for you, from owning your first rental property with the least amount down to opening up financing possibilities that will help you get your deals approved. My name is Dalia Barsoum. I am the founder of Streetwise Mortgages, and welcome to the Streetwise 10. When it comes, guys, to down payments, we are going to move beyond percentages in this video. I am going to give you the strategic clarity that you're looking for using real numbers. Understanding this is the key to building a capital plan that actually works in today's market environment. And that is the difference between a successful purchase and wanting to buy something and seeing it fall apart because of down payment in the last minute. Let's start with the baseline that everyone knows about, the 20% down. In Canada, if you are buying a residential rental property that has 1 to 4 units, most conventional lenders, such as the banks, will require you to put 20% down if you will not be living in one of the units. Very few lenders on the street, guys, would also do the same on 5 and 6 residential rental properties. So consider that option before you assume that you have to finance a 5-plex or a 6-plex under commercial financing, which is typically a lot more expensive. Now, if you want to put less than 20% down on a rental property, you must live in one of the units. And in that situation, the lenders will add what's called a mortgage insurance to your mortgage. That mortgage insurance is calculated as a percentage of the loan and is provided by mortgage insurers such as CMHC. So in a nutshell, if you are not gonna live in one of the units, then it's 20% down. But if you're gonna live in one of the units, that down payment can be less than the 20% down, and we're gonna talk about that. And that mortgage has to be insured, meaning that you are going to pay a premium on that mortgage to be able to get into the deal with less than the 20% down. A major exception to this 20% rule is if you are planning on living in one of the units of the property that you're buying. This strategy is called house hacking. When you occupy one unit of the property, that is considered an owner-occupied property, although some of the other units in the property will be rented. And for that, your down payment drops from the 20% down as low as 5% down. However, it is not a flat 5%. It is what's called a sliding scale. So let me show you through real examples, what would that look like? In Canada, you can purchase with less than 20% down up to a purchase price of $1.5 million. This applies to a primary residence with no rental units, or a rental property where you're going to live in one of the units and rent the other units. And here is how the numbers play out. It is basically a sliding scale. So the calculation is 5% on the first $500,000 and 10% on the remaining amount. So anything above the $500,000. Let's look at a real example. Let's say you're looking to purchase an $800,000 property. The down payment below 20% would look like this. 5% of the first $500,000 plus 10% of the remaining amount, which is $300,000. So 5% of $500,000 is $25,000 plus 10% of $300,000 is $30,000. And in this example, our total down payment would be $55,000. Here is another example. Let's say the purchase price is 1.2 million. Here is how the sliding scale would look like. 5% on the first 500,000 plus 10% on the remaining amount, which in this case is the difference between the 1.2 and the 500, and that's the 700,000. So here's how the numbers play out. 5% of 500,000 is 25,000. 10% of the 700,000 is 70,000. Therefore, our total down payment in this example is 95,000. As you can see, this is an effective strategy for acquiring a high value multiplex up to 4 units with less than 20% down. Again, as long as you're going to live in one of the units. The reason that the scale stops at $1.5 million is because that is the price ceiling, that is the maximum price ceiling at which a mortgage insurer in Canada would do an insured mortgage. So if the price is above $1.5 million, regardless of whether or not you're going to live in the property, you will need a minimum of 20% down. So just remember that. Okay, so you have planned for the down payment of the baseline of 20% down. But this is where investors can get surprised. The final amount you need often comes down to 3 critical factors. The first factor is your personal qualification. If you're buying a rental property that has 1 to 4 residential units, personal qualification is going to play a major role in determining the final down payment you have to put into a deal. So let's look at a quick example. Let's say that you are buying a rental property and you're gonna rent all units, you're not living in one of the units, and the rental property has 1 to 4 units, and you're buying it for $500,000. And the typical down payment, as we know, would be 20% down, and that is $100,000. So your mortgage on this property technically should be $400,000. That's the mortgage amount you should technically qualify for. But because it's a residential property, the lenders are going to look at your personal income and your personal debts and determine how much mortgage you qualify for. So yes, on paper, it should be $400,000, but if your personal situation qualifies you for a mortgage, let's say of $350,000, then this means that your down payment now goes up from the $100,000 to $150,000. This is why it's super important for you to speak with a mortgage advisor early on if you're looking to purchase, and not just go through the pre-approval process, but go through what's called a pre-qualification process, where they're taking a close look at all of your income, all of your debts, and guiding you as to the maximum mortgage you can qualify for. So be proactive, get your pre-qualification numbers early, because the fact that it's 20% down doesn't mean that that's what you're gonna end up with. Having said that, in Streetwise, what we do with clients is we obviously understand that you don't want to tie too much capital into a deal, so we help you determine how you can get in and continue to get in with 20% down, or even less if it's possible for you. The second critical reason that would impact how much down payment you put into a deal is the type of property you're buying. If you're buying a commercial property, or a mixed-use property, or let's say a residential property that has 5 or 6 or more units, then you are looking at commercial financing. And under commercial financing, guys, the down payment is not a straight 20% or a straight 25%. The down payment is dependent on the property's net operating income. You can watch my YouTube video on this channel about financing for multifamily properties to better understand how to calculate the down payment for this type of property. But in a nutshell, it could be 25% down, it could be 30% down. It is all dependent on how the property itself qualifies for the mortgage. Having said that, when it comes to 5 or 6 unit residential properties or multiplexes, there are very few lenders on the street that will deal with that as if it's residential financing, and they will look at your personal income to qualify for such deals. So these are the third factor is if your deal is more complex. And what I mean by that is, let's say you are buying a student rental, or let's say you're going to invest in short-term rentals, Airbnbs, or that you're not reporting enough income on your tax returns, and therefore you cannot work with the banks but have to work with an alternative or a B lender. In that case, the lenders may require a higher down payment than the 20% down. And again, if we're assuming here that you're buying a residential property that is 1 to 4 units, the final number is going to depend on your personal qualification, but that lender may require an extra down payment into the deal, again, because of the nature of your investment strategy or how you report your income. With B lenders, for example, sometimes they require a minimum down payment of 25% down in certain locations, and they can go with the 20% down in other locations. So these are the 3 critical factors that will determine your final down payment. Now, I know that some of you are thinking about the promise of buying a property with a 0% down. Is 0% down possible in Canada? As a mortgage advisor, seeing thousands of real estate investment deals come to my desk, the answer is yes, it is possible. You may ask, how? How can I buy something with 0% down? Well, here are quickly the different ways you can do it. You can get a private first mortgage on a property, and you can negotiate a mortgage from the seller behind that mortgage called a vendor takeback. Or you can negotiate a mortgage from the seller called a vendor takeback and have that as your first mortgage. And it's all about negotiation. Or you can utilize other people's money through joint ventures, for example, where you bring other people's money into your deal, and you can then set up a private mortgage or a traditional mortgage or a vendor take-back mortgage or a combination of all of the above, depending on how the numbers play out. And by doing so, you're technically putting 0% in the deal. Have I seen these deals? Absolutely. On the residential side, I've seen them when the markets are slow. I've seen them when the seller is motivated. On commercial deals, they are a lot more common in my view. Now, I love creative financing. I've personally used it as an investor as well. But if you're starting out, I highly suggest that you stick with the fundamental ways of buying an investment property. Do not jump into these high leverage strategies, more complicated money strategies when you're starting out. I am deeply concerned sometimes about investors jumping into a deal with high levels of debt, such as a private mortgage and a vendor take-back, and not understanding that taking such a high risk position can actually hinder their success if the market turns, like what we've seen in 2024 and 2025 in Ontario, or if you haven't thought about or validated how you're going to pay that money back. Things can really haunt you if you use high debt leverage. Utilizing other people's money is a strategy that I've seen more commonly, I would say. But again, as a starter investor, it's best to stick with the fundamentals. See how you can get into the market with a 5% down. See how you can utilize equity as far as you can take it. And then you can consider utilizing more sophisticated money strategies like that. All right, you've determined your down payment, but that's not the final number you need to purchase a property. The last piece of your capital plan is budgeting for your closing costs. And how lenders look at these funds is very different depending on the type of mortgage that you're being approved for. As a rule of thumb, your actual closing costs in a place like Ontario would range from 2 to 4% of the purchase price for things like land transfer tax and legal fees. But here's how the lender verifies you have that money. For insured mortgages, these are mortgages where you're putting less than a 20% down if you're gonna live in the property, or if you're going to do a house hack by renting some units and living in another unit. Although your actual closing cost is higher, the lender wants to see that you have that 1.5% in your bank account. And they're not looking just for a snapshot, they're looking for a 90 days history. And if you are getting that money as a gift from a close family member, they would want to see a gift letter and not necessarily the 90 days history. Now, if you are getting approved for a mortgage where you're putting 20% down, the lenders don't actually care about seeing the closing costs in your bank account, because they believe that if you can afford putting a 20% down, then you are well capitalized. The same thing applies to commercial mortgages. The takeaway is, no matter what the lender requires you to prove, a smart investor always has a precise budget for closing costs. Not having this cash ready to go can really put your deal at jeopardy in the last minute. So, how much do you really need for down payment for your next investment property? Is it 0 down? Is it less than 20% down? Is it the 20% down, or is it more? As you have seen, the answer isn't a single number or a single percentage. It really depends entirely on your investment strategy, on your personal qualification, and the type of property you're buying. The key is to know your financing path and financing options way before you make an offer. So you gotta give yourself ample time. If you want clarity on where the money's gonna come from for your down payment and closing costs, how much you will need for your next purchase, and what type of financing is suitable for you, we can help you. We can help you connect the dots and create a capital plan that maps out exactly the how. We can also bring to your awareness options that you may not have thought about or considered in the first place. Click the link in the description to book a confidential and complimentary call with one of my team members at Streetwise Mortgages. This was question number 2, folks, in the Streetwise 10. Make sure you're subscribed, because in the next episode, I will answer a question every new investor asks, which is, how do I finance my first investment property? Tell me, what was the down payment on your first rental? Share your experience in the comments below. Thank you for watching, and as always, stay streetwise.